Have you ever wondered how some people grow their money while others just let it sit in the bank? The difference often comes down to one thing: the stock market. Now, I know what you might be thinking. The stock market sounds complicated, risky, maybe even scary. But here's the truth. Once you understand the basics, it's actually a simple and powerful tool for building long-term wealth. Today, I'll break down the fundamentals of the stock market in a way that's easy to understand. No jargon, no confusion, just clear explanations and examples you can actually follow. By the end of this video, you'll know what the stock market is, how it works, who regulates it, and how beginners like you can start investing smartly. First, what is the stock market? Think of the stock market as a giant marketplace. But instead of buying apples, bread, or clothes, people are buying and selling pieces of companies, debt, or even commodities like oil and gold. The most common thing traded here is stocks. A stock represents ownership in a company. When you buy one, you literally own a slice of that business. But stocks aren't the only players in this marketplace. You also have bonds, loans you give to companies or governments, commodities like gold, oil, or wheat, derivatives, advanced contracts like options and futures. So why does this marketplace exist? Simple. Companies need money to grow, and investors like you want their money to grow. The stock market connects the two. Companies raise capital by selling shares, and investors get the chance to profit when those companies succeed. At its heart, the stock market is powered by the oldest rule in economics: supply and demand. If more people want to buy a stock than sell it, the price goes up. If more people want to sell than buy, the price goes down.
Now in the US, there are two main stages where this action happens. Number one, the New York Stock Exchange, NYSE. Founded in 1792, it's the world's largest stock exchange and home to companies like Coca-Cola, Walmart, and Disney. It's the traditional Wall Street you see in movies, with traders shouting on the floor. Then comes NASDAQ. Born in 1971, this was the first electronic exchange. It's tech-heavy, hosting companies like Apple, Amazon, and Microsoft. If New York Stock Exchange is the classic theater, NASDAQ is the futuristic digital stage. There are also specialized exchanges like the Chicago Board Options Exchange, but for most beginners, knowing the New York Stock Exchange and NASDAQ is enough. Why does this matter? Because these exchanges are where the biggest companies in the world trade, and they set the tone for markets globally. When you hear news like, "the market went up today," it usually refers to these exchanges. Now, who keeps the market fair? The SEC. If the stock market is a game, then someone has to enforce the rules. That's where the U.S. Securities and Exchange Commission, SEC, comes in. The SEC was created after the Great Depression in 1934, and its mission is clear: protect investors, ensure fair and transparent markets, and prevent fraud or manipulation. For example, public companies are required to share their financial statements so investors can make informed decisions. The SEC makes sure this information is accurate and that companies aren't hiding bad news. Think of the SEC as the referee, making sure no one cheats, so you can invest with more confidence. Moving on to these stock market indices. Here's a question. How do you know if the overall market is doing well or badly? That's where indices come in. An index is like a report card for a group of stocks. Instead of tracking thousands of individual companies, you look at a few big indices. Number one, Dow Jones Industrial Average. DJIA tracks 30 large US companies. It's one of the oldest and most famous indices. Number two, S&P 500 tracks 500 of the largest US companies and gives a broader picture of the market. And number three, NASDAQ Composite includes all companies listed on NASDAQ with a heavy weight in tech. So when news says the market is up 2% today, they're usually referring to one of these indices. For beginners, think of indices as the scoreboard of the stock market. So, how do you start investing? Here comes the trading accounts and brokers. Before you can buy your first stock, you need a trading account. Think of it as your ticket to the marketplace. Here's how it works. 1. Choose a brokerage. This could be a traditional firm like Fidelity or an online app like Robinhood, E-Trade, or Charles Schwab. 2. Fill out an application. They'll ask for basic details about your finances and investment goals. 3. Fund your account, connect it to your bank, and transfer money in. Once that's done, you're ready to buy and sell stocks with just a few clicks. Now, what exactly does a broker do? They're the middleman. They connect you to the stock market. Some brokers are full service, offering research and financial advice, while others are discount brokers, charging lower fees but leaving most decisions to you. Pro tip: if you're a beginner, focus on brokers with low fees, easy-to-use apps, and educational tools. Don't overpay for fancy services you won't use. Another important thing: why budgeting matters before investing. Here's a mistake beginners make. They jump into investing without checking their personal finances. But investing without a budget is like sailing without a map. Start by asking, how much money comes in each month? How much goes out for rent, bills, groceries, etc.? How much is left over for investing? Always build an emergency fund first, at least 3 to 6 months worth of expenses. That way, if life throws a curveball, job loss, medical bill, car repair, you won't be forced to sell your investments at a bad time. Only after you've got your safety net should you put money into the market. Remember, investing is a marathon, not a sprint. You want to stay in the game long enough to see your money grow. There's a smart strategy for beginners called dollar cost averaging, or DCA. This is where most new investors trip up. They try to time the market, buying when they think prices are low and selling when they think prices are high. But even professionals get this wrong. Instead, use a simple but powerful strategy called dollar cost averaging. It works like this. You invest a fixed amount of money, say $200 every month. When prices are high, that $200 buys fewer shares. When prices are low, it buys more shares. Over time, this evens out your cost per share and reduces the risk of bad timing. The best part? You set it up automatically. Your broker can schedule recurring investments so you don't even have to think about it. This builds discipline and keeps your emotions out of the equation. DCA is perfect for beginners because it turns investing into a habit, like paying yourself first every month. So let's quickly recap what we covered today. The stock market is a giant marketplace for buying and selling ownership in companies. The biggest US exchanges are the New York Stock Exchange and NASDAQ. The SEC is the referee that keeps the market fair. Indices like the S&P 500 act as the market's report card. Just to get started, you'll need a broker and a trading account. Budgeting and building an emergency fund come first. And finally, strategies like dollar cost averaging help beginners invest wisely over time. The stock market isn't about getting rich overnight. It's about building wealth step by step. With patience, discipline, and the right strategy, you can make your money work for you.
Imagine you're standing at a fork in the road. One path says mutual funds, the other says index funds. Which one should you take? Even legendary investor Warren Buffett has weighed in on this choice, and his answer might surprise you. Today, we're going to break it all down with the help of John Bogle's classic book, The Little Book of Common Sense Investing. By the end, you'll know exactly which road fits your journey.
So, what are mutual funds? Think of a mutual fund like a basket filled with different fruits: apples, oranges, bananas. Instead of buying just one fruit, you buy a slice of the entire basket. That basket is managed by professionals called fund managers, who decide which fruits to add or remove. Pros: diversification, professional management, and convenience. Cons: higher fees, human error, and sometimes the fund underperforms the market. Here's the catch. Not every manager is Warren Buffett, and while you pay higher fees for their expertise, there's no guarantee they'll beat the market.
Moving on to index funds, the simpler basket. Now, imagine a basket that doesn't rely on a chef deciding what goes in. Instead, it copies a recipe word for word. That's an index fund. It simply tracks a market index like the S&P 500. The S&P 500 represents 500 of America's biggest companies. The Dow Jones tracks 30 blue-chip giants. The NASDAQ is tech-heavy with companies like Apple, Microsoft, and Google. Instead of guessing which stock will win, you just buy the whole market. Simple, low-cost, and effective. Downside? It can't pivot. If an industry in the index struggles, your fund struggles too.
Now, let's understand active versus passive styles. Here's where the philosophies differ. Mutual funds equals active management. Fund managers try to beat the market using research, predictions, and timing. Index funds equals passive management. They don't try to beat the market, they are the market. One style chases outperformance, the other relies on consistency. Which sounds less stressful to you?
Mutual funds often charge higher expense ratios. That's the fee you pay to keep the fund running. It covers research teams, trading, and salaries. Index funds? No high-paid managers making daily decisions. Fees are usually a fraction of what mutual funds charge. And here's the kicker. Fees compound just like returns. A small 1% fee can quietly eat thousands of dollars from your future wealth over decades. Rebalancing and updates. Markets aren't static. Indexes like the S&P 500 update over time. Companies that fall behind get dropped, while stronger ones join in. That means your index fund automatically adjusts, cutting out losers and keeping winners. It's like your portfolio naturally upgrading itself without you lifting a finger. Performance over time. Here's the truth. Some mutual funds do beat the market, for a while. But over the long run, studies show most actively managed funds fail to outperform their benchmarks, especially after fees. Index funds, on the other hand, simply mirror the market. You won't get flashy short-term wins, but you also won't lag behind. Slow and steady often wins the race, especially when building wealth over decades.
Wisdom from Jack Bogle.
John Bogle, founder of Vanguard and father of the index fund, put it simply: most investors are better off in low-cost index funds. Compounding is the eighth wonder of the world. Start early, invest consistently, and let your money snowball. Over time, the results can be life-changing. Risk and reality. No investment is risk-free. You've got systematic risk equals market-wide risks like recessions. Unsystematic risk equals company-specific risks. Index funds reduce unsystematic risk through diversification, while mutual funds rely on managers to avoid mistakes. And remember, timing the market is nearly impossible. Even the pros often get it wrong. Consistency beats guessing. Here comes an important concept called dollar cost averaging, or DCA. Instead of waiting for the perfect time, many US investors use dollar cost averaging. That means investing a fixed amount on a regular schedule, for example, every paycheck, into your 401k or IRA. When prices are high, you buy fewer shares. When prices are low, you buy more. Over time, this averages out and helps smooth volatility. Pair that with index funds' low fees, and you've got one of the simplest, most effective investing strategies available. The bottom line. Mutual funds offer expertise and flexibility, but come with higher costs and uncertain results. Index funds keep things simple, cheap, and tied directly to market performance. For most beginners, index funds combined with dollar cost averaging is the easiest way to build long-term wealth.
So, which road would you take? The actively managed path or the simple passive road? Drop your answer in the comments. And if you found this breakdown helpful, hit that like button, subscribe for more, and share this video with someone who's just starting their investing journey. Because remember, investing doesn't have to be complicated. Sometimes, common sense is the smartest strategy.
Check out our other videos where we break down finance and investing concepts into simple, easy to understand lessons. Your journey to financial confidence starts here, and the best time to begin is today.